understand when they used to say that. I'm like, no, you guys are exaggerating. I mean, the year is still on. I get it now.
Yeah.
Like I owe some teachers and people like serious apologies.
Yes. So on my plan, I'm actually planning for 2023 already.
Yeah, because
dealing with 2022, it's done.
if January is gone now, we can only imagine what's going to be
Yes.
happening going forward.
Yes.
Anyway, let's get straight into it in the interest of time.
Yes.
What is it about? In fact, what's the background that you can give us on the companies before we go straight into the taxable part of things, etc., etc.?
Yes.
Yeah.
So with companies, I want to take it slow.
Yeah.
Because we're meeting different entrepreneurs at different levels of
Okay.
the entrepreneurial journey.
Okay.
So we don't want to leave anyone behind. We want to take it slow. And for those that are ahead in the journey, maybe you'll pick up something new, maybe one or two things.
Or fundamentals. Yeah.
That you may have missed along the line.
Yeah.
But we're going to take it slow because we're dealing with SMMEs.
Yeah.
Mostly people that are in a position not to be able to hire an accountant who can give this information to them.
Right.
Who are doing everything on their own. They need to specialize in their field and they need to know accounting and company tax law and all sorts of things. So we want to take it slow.
Okay.
Yes.
Right. What is a company?
So there are a number of vehicles which you can use to trade.
Okay.
I'm going to focus on 3 for the purposes of time. And what you can do, if you've got a business idea, you can literally wake up and start trading today with no registrations, and you just do your thing. So you can literally wake up and decide, I'm going to make money by washing people's tackies, for example.
Right.
You do that in your personal capacity. You get the income. That is called a sole proprietorship.
Yes.
Where it's one person working as in this particular trade, and there's no registrations that you've done.
And it's run by that person.
It's run by that person. 100% managed by that person. That is what we call a sole proprietor.
Okay.
Now, I want to go through some pros and cons as well as we talk through these sort of business
those are important.
Entities. Yes. Now, the pros of, if we look on the positive side, why you would want to become a sole proprietor is because you've got 100% control and ownership of the business.
Okay.
It's your baby. You run it how you want to. There's no external persons that you need to report to or you need to touch base with.
Is that like a spaza shop?
Typical spaza shop.
Right.
Yes.
Right.
So you wake up, you do your own thing, how you do it. You manage your own hours, you manage your own time, and you manage your own product how you want to run it.
Okay.
With that, there's certain disadvantages. Of course, we know businesses is not guaranteed to succeed. So where the business does not succeed, all the losses then fall on you because and
you're the one who put in. And
yes.
You're the one who's going to lose.
So if the business fails, it's 100% then on you. So all the risks
unless you owe somebody, then you're in trouble as well.
I'm getting to that. So with that, if you incurred any debt, so say you bought, you took out a loan on behalf of the business to set up the business, to buy your starting materials and everything. When the creditors come knocking for that loan, you then become personally liable to pay back.
Okay.
And the creditor can even attach your personal assets. So they can go into your house, attach your personal television, your personal laptop,
beds,
your couch,
the dog,
children's school bags. Yes.
Oh man. So you're not protected in that sense.
You're not protected.
Okay.
Yeah.
Okay.
But you've got that flexibility to formalize at a later stage if you so wish.
Okay.
But if you need something up and running today, you can literally start trading in 2 minutes time.
Got you.
With that business entity. And moving on to the next business entity that one might look at is a partnership.
Okay.
So say you've got a certain skill set and you want to partner with somebody with a different skill set. That's something that you can look into as well. So you formalize a partnership with somebody. For example, if True and I want to make an events management company,
Right.
True's got all the media expertise and I've got all the business expertise. That is a great combination for a partnership.
Right.
True would be in charge of all the media and the setup of all the events and everything, and I would look at the books and the running of the business on that end.
Okay.
And you see, we've got different strengths. It looks like we're pulling in different directions, but we're pulling for the same end goal.
Sure.
That is what then a partnership is.
Is it registered?
It is not.
Okay.
It would help to have a document that assists the running of the partnership.
So a guiding document that talks to your execution,
yes.
But the actual partnership is not registered.
No.
Okay.
It's not important. It is important to have it, but it's not a prerequisite. So we can literally have a verbal agreement that, listen, True, we're going to do this, and we go on that verbal agreement. The disadvantage with the verbal agreement is if we have in 2 years' time, 3 years' time, we don't see eye to eye. But if we've got that guiding document, documented and signed by both parties, then that is how we then continue the partnership.
And I mean, as much as the actual partnership is not registered, it doesn't hurt to have a legally binding document between the two of you.
It doesn't.
That says, my responsibilities go to this extent. This is how much I'm putting in for the capital investment, etc., etc. So that when the sky does fall, we walk away from there like, well, that's what we signed for. So let's split it like that and call it a day without the roundhouse kicks.
And not even looking in terms of the negative aspects.
Yeah.
Even when we make a huge profit from our business, how do we share the profit?
Sure.
Do we go 50-50?
Is it relative to what we invested?
Yes.
Sure.
Is it relevant to the skills that we're bringing in?
Sure.
Because if we look at the example of an events management company and we look at your strengths versus my strengths, in terms of events management, you would be pulling more into the business than I would.
Right.
We would then come in once a week or once a month to do the books.
So when 3 million rand comes into the account, now we're like, what do you mean half?
Exactly.
Got you.
So those are the pros and cons of a partnership.
Is that similar to a joint venture?
Different to a joint venture.
Okay.
That's a different vehicle. It wasn't on my plan to speak about it, but we can speak briefly about it. A joint venture is where you've got your existing business and I've got an existing business, and we see a gap in the market which we want to penetrate, and you've got some level of skills to penetrate, but not to the full extent that you can capitalize. And then we then join into this particular,
as two companies becoming one force.
Yes.
Okay.
And then we can set the parameters for that. Is it for a certain period? Is it for a certain purpose? Or is it indefinite? So it's very different to a partnership. It's a very different vehicle.
We'll get to it at some point, because I see that there's a lot of unpacking to do when we get there.
Yes.
Okay.
The third vehicle that I had prepared for today was a private company.
Okay.
That is where you approach the CIPC and you register. This is now where the registration comes in.
Sure.
You register a company and you call it ABC Company, and you've got your list of things that you're going to do in the company, and it's a separate person to you as an individual. So
it's got its own tax number.
It's got its own tax number. It can sue and be sued in its own capacity. And then there's limited liability. So if you put in 50,000 as the shareholder of the company, the 50,000 transfers from you, the individual, to the company. So it's no longer yours. It belongs to the company, because the company is a person in its own capacity to do with that 50,000 injection what it needs to do for the company.
So we are better a company.
Let's put it like that. Yes.
Because imali yompheja ayibuyi mos.
But the benefit with the company is that there is potential that it can come back.
Yeah.
Because you are the shareholder, you would then be in a position to draw dividends from the company at some stage if the company manages to multiply that 50,000 injection.
And I mean, you share your expertise with the company. That's in hopes that those are going to direct it towards a profitable position.
Looking at the benefits of a company is because it's a separate person.
Yeah.
People can come and go into the company as without interfering with the structure of the company. Unlike with the sole proprietorship or the partnership, you can literally have 5 shareholders at some point. A shareholder decides to resign. You have 4 shareholders, 3 shareholders decide to join.
20, or however
yes,
how much cash injection you would be needing at the time.
That's correct.
Okay.
So the shareholding does not impact the structure of the company.
Got you.
So once it's registered, it's its own person, and it can have shareholders come and go without interfering with the structure. Unlike a sole proprietorship, if you want to bring on somebody on board, it obviously can then not be a sole proprietorship, because in the name sole means one. Therefore, if you bring somebody on board, it will either be in the capacity of an employee.
What if it's like sole proprietorship?
No, different type of sole.
Like soul
spelled differently means different things. And then in a partnership, so if the two of us venture into a partnership and we want to bring a third party on board, what would need to happen is that the partnership agreement that the two of us had would need to dissolve, and a new partnership would need to be formed with the third party.
Because you don't amend the original one. We have new terms because we've got a third party that might be coming with a different approach.
I mean, the amendment of the original one is in effect changing the whole thing, because a partnership can have 2 or up to 20 people.
Okay.
So the moment you bring someone new, it's a whole new partnership.
What's it called? What's it called when there's 21 people?
Then you need to register some other kind of business. Then you need to look at into a private business where you'll have then 21 shareholders.
Okay. Yeah. Okay.
So those are the different vehicles that you can look at, and the tax consequences of each of them are very different, as they are also very different.
Okay.
With a sole proprietorship, you are 100% the owner. The business itself does not have a separate tax registration, so everything that flows through the business is for the individual. So when you want to submit your tax return, what would happen is you would need to fill out all your personal details and your personal income and expenses, as we discussed last year.
Yes.
And then in addition to that, on that same return, you would then include the business elements of the return as well. So remember, when you open up the return, there's a whole question and answer section where you need to answer yes or no to certain questions. There'll be a question there in terms of, did you conduct a business? You would then need to answer yes, and then the business part of the return would open up for you
drop-down menu
to populate what happened in the business for the year. What were the assets? What were the liabilities? What were the incomes? What were the expenses?
Turnover.
And then you would be taxed on the profit of the business. Now, the disadvantage, let me start with the disadvantage. The disadvantage of this is, if the business had a really good year and it made a lot of profit, that pushes your tax liability up. Yes.
So more money, more problems.
He did it, said it first. He said it, and it's still true.
Is there a threshold to that? I mean, there's people with obscene wealth, and then there's rich people. Then there's moderately rich. Then there's middle class, which most of us aspire to normalize our lives and get to a certain stage. We're talking now the people who are dealing with billions.
Billions.
What tax structure is there in place for?
There is no threshold.
So it's according to what you got.
You could be dealing with billions in your own personal capacity. There is no threshold. There are obviously advantages and disadvantages when you get to that. If we're looking at somebody who's turning over R1 billion or making a profit of R1 billion, you would be at the top tier of the tax table.
The 1%.
Because when we look at tax, we look at according to the tax tables. Remember, you get taxed at a percentage depending on your income. So starting from 18%, 26, 35, etc., all the way up to 45%. So if you are going to be trading as an individual in the billions in your personal capacity, you're putting yourself in a position where you're not really making good tax choices, because you're putting yourself where 45% of your profit is being taxed.
Oof. Imagine being taxed $500 million after making $1 billion.
Yeah.
Ouch.
Yeah. So there is no threshold. However, it does not make economic sense. You would then need to bring someone in like a tax practitioner or an accountant to give you better advice on how to package your company to make more financial sense. Because at the end of the day, we go into these businesses to make money. So you don't want to give it all away to the revenue authority.
And this is why extremely wealthy people invest in a lot of property.
Yes.
Immovable assets, so that their money is not liquid, because if it stays in the bank, they're gonna get you. They're gonna get you, Cletus. They're gonna get you.
And then looking at the other tax consequences for the other two vehicles very quickly. In a partnership, what would happen is, remember, the partnership is not a separate person.
Yes.
We've got this verbal or written agreement between the two of us, and we've got our profit share percentage.
Yes.
You get 70%, I get 30%.
Okay.
So we get an accountant to work out the profit for the business, and then if the business makes a profit of R1 million, we then share the million between the two of us. You get 700, I get 300.
Right.
And then we take that amount into our personal income tax returns.
And that's when the receiver gets involved.
Yes.
Okay.
That's correct.
Okay.
So the receiver doesn't get involved at the level of the partnership. So we split the partnership profits or losses, and then we put the amounts on our personal income tax returns.
How do we split losses? I'd like to hear
So
this.
if we make a loss of 500,000, we go again, look at our profit share agreement. And the share agreement is actually a profit or loss share agreement.
Damn, I got to pay back 70%.
So if we settle on 70-30, everything is 70-30, whether it be profit or a loss.
Got you.
So if the partnership needs to take a loss, then the loss would be shared in that percentage ratio as well.
Okay, got you.
Yes. And then that goes into then your personal income tax return. Once again, you'd open up your return.
Damn,
one of the questions,
350,000 rand I got to pay back.
Yes. But there is a silver lining. So what you would do on your personal income tax return, so you working at KNR, you would declare all your income from KNR, and then we've also got this partnership thing going on the side, which made a huge loss in the last year. So then you would put in the partnership loss, which would then drop your taxable income.
Ah, got you.
Yes. So there's the silver lining then, that
my cushion was that I made a loss.
Yes.
And it brought me down.
Yes. But of course the receiver would probably audit you. But that is not a train smash, because you are a
compliant
individual who would keep all your paperwork, and you've obviously got me who would assist you with that.
You see? You see? I know people in high places.
Right?
Oh, man, listen, it's 5 minutes before 12.
Cool.
You wanted to give us the tax implications on, we've done partnership.
Yes.
We've done sole proprietorship, which is similar in the tax liability sense, because it's only once it gets to your account does the receiver get involved. And obviously for the company, it's a different story because
for the company, it's a very different story. Remember, the company is a separate person.
Yes.
So you working at K&R, you would file your personal income tax return as per normal. And then the company, which is a separate person, would have its own e-filing profile. It has its own tax number. It files its own tax return. It's in its own capacity as well.
Right.
Yes. So that's completely separate from the shareholders or the owners or the founders of the business.
We have a couple of comments here. Kwandam Kabela says, much needed information. Hands in the air saying good stuff. Thank you, Mr. Mkabela. And September Mtutuzeli says, I hope first, second, and third year students are listening free lecture class. Big up to Keith and YC Radio.
Wow.
Thank you.
Chills. I would not consider myself a lecturer.
Well, you know what? That's what most people will say when the intention was just to share information. Theirs is just structured. There's no difference between what you and a lecturer do.
Really? That's amazing. Thank you so much for the feedback.
Thank you, guys. Listen, you could have been anywhere between 9 and 12. This is where you chose to be, and for that, we are eternally grateful. Thank you for making Moment of Truth your 9 to 12 destination. Until tomorrow, take care of yourselves so we can take care of each other.
Ladies and gentlemen, let's see what all the from the states of Africa.